Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Welcome back to the Massive Passive Cash Flow podcast. I'm Gary Wilson, your host, and I'm glad to have you back. Hey, if you wouldn't mind doing so, if you haven't already done so, is please subscribe to the podcast. It's on 30 different channels, including your all-time favorite Apple. So whichever one you're on is fine with me. And while you're out there, please click on globalinvestoragent.com. These are real estate agents that are not typical. They're trained to work with you and I, the investor. Okay, they know how to identify, analyze, and attract and negotiate on and off-market transactions, both residential and commercial. We've done deals as little as 100,000 and as big as 165 million. So get one of these folks to work with you. That's the point. And if you are an agent and you're not sure what you're going to be doing with this market shift coming up, I suggest you click on the Learn More button and figure this out because it should be part of your model. So in any case, without further ado, we got a great guest today, Ben Fraser from the beautiful state of Kansas. We were just talking about that in sports, and I didn't mention barbecue, but my favorite barbecue happens to be in Kansas City. So Ben, first off, thanks for doing this. I know you're busy. I've looked at what you guys are up to. Pretty impressive. So I know we're lucky to have you on board,
Yeah, thanks for having me, Gary. It's really, really fun. So
yeah.
What's your favorite barbecue place here? We didn't talk about it before.
Well, oddly enough, it's actually Dave's. I know it's a chain, but and I've been to Memphis. I've been all over the country eating barbecue. And I first came across Dave's in, where was I? Colorado, somewhere outside of Colorado. And so wherever I go, I would look for it because I don't know how they do it, but it's really good.
It's good. That's why, in Kansas City, we don't have any mountains or beaches, so we just do a barbecue really well, and we love our sports teams. So that's what we're known for.
It is a fun place to be, no doubt about it. I've been there many times. Hey, if you wouldn't mind, tell us a little bit about how the journey that took you to where you are today, and then we can jump into what it is you're doing today too, and what you see coming down the road, if you don't mind.
Absolutely, yeah. So I'm currently the Chief Investment Officer at Aspen Funds. So Aspen Funds, we're an Inc. 5000 company and really focused on alternative investments, mostly in real estate, but also in oil and gas, as well as some kind of debt offerings. But my journey kind of started, back in banking, which it sounds like you came from banking world as well. I was on the commercial side, doing underwriting for business loans, did a lot of mergers and acquisitions, did real estate, and really kind of cut my teeth learning how to underwrite and break down a deal, evaluate risks. And it was a great learning experience, a great place to kind of see how things are really underwritten well. But I saw, projected a few years out and saw most people that stayed in banking for a long period of time ended up becoming pretty pessimistic. The glass is always, half empty, and you're only ever thinking about the downsides, right? Because as a bank, you don't get into the upsides. And for me, that wasn't very fun. And so I really wanted to get on the equity side of things and really explore more of the investments. And so kind of taking that background in banking and underwriting and kind of bringing that into the types of deals that we do. And, kind of for your audience, what was really interesting to me when I was an underwriter and, looking at all these borrowers, one of the cool things that I got to do, my favorite part was looking at the personal financial statements of all these very wealthy borrowers of the bank, right? Because everything is right there and they have to disclose it all. And so you can literally see exactly what they've done, how they made their money and what are they invested in. And for me, it was kind of this under the, engine look at, or under the hood look at what's, these people doing to be successful. And one of the most common denominators was real estate, right? Generally, these borrowers had a lot of holdings in real estate. And so to me, it was kind of this, light bulb moment of wanting to kind of move into that direction and really kind of build my own net worth in that. But then, as you are aware too, with some of the changes in regulations over the past few years, it's really opened up the gamut for investors to be able to invest passively in a lot of these types of deals, not just having to do their own deals. So that's what we do now. And we've raised about $200 million over the past several years in equity from just high net worth investors. And been going about 10 years now.
Yeah. What's interesting is banking was actually my third job, but it was really my career. In the corporate world, I was in banking for almost 20 years actually.
Okay.
And the bank I started at was called Sovereign Bank in Virginia, and Sovereign eventually merged with NCNB out of Atlanta, and then what was called that was Citizens Trust, and then NCNB out of Charlotte, North Carolina, gobbled that whole thing up and called itself Nations Bank. Nations Bank bought Bank of America and took the Bank of America name. So, in any case, when I was at Sovereign Bank, instead of going out to lunch every day and hanging out with the guys, I would actually go up to the corporate library and study and learn all about, the commodities and the stock market and all that, and actually did really quite well in the stock market. And that was my seed money that I used a few years later to start investing in real estate. But I learned a lot about investing just from being in the bank, and a lot of our clients, of course, were very high net worth people. So I got to learn a lot about all the different ways. So that's why the podcast, we obviously my superpower is real estate, but we routinely have people on to talk about gold, silver, oil, gas. I mean, if you think about what consumers need and want, housing is just one part of it. It's a big part of it, but just one part of it. And if you can be part of industry that's providing a valuable product or service to people that they need every day, you're going to make money. You're going to do well. So let's talk about that a little bit. You mentioned oil and gas. What are some of the things, as much as you're able to share? I know there's probably some rules about this, about names and naming businesses and things like that. But maybe an example or a case study. In what sector would you say? What's your biggest sector right now that you're when you're raising funds for to invest in?
Yeah. Great points. And the way that we invest is probably a little bit different than a lot of people that are in real estate, right? Because what most people do that are operators will be picking a single asset class. Say multifamily is probably the bread and butter of most, commercial real estate operators. And while there's some efficiencies to be gained by vertically integrating and getting really deep into one asset class, the downside of that model is if things kind of shift over time, right? If the cycle is not in your favor, you're kind of stuck holding a bag of something maybe you don't want to hold. And so what we've decided to do, and really kind of goes back to the genesis of why we started Aspen, is really be more opportunistic. And so our kind of tagline is macro driven alternative investments. And so we're kind of first looking top down. What are the economic trends that we believe will be going on for the next, several years, if not decade plus, that will support the investment theses that we kind of put together for our deals. And so I want to make that point because I do think it's important to invest with the economic tides, is what we call them, because intuitively understand that as investors, where there's good times to be investing in certain asset classes and there's bad times. And great examples are investing in tech in the late 90s versus investing in tech in early 2001, right? And investing in real estate, in commercial real estate and single family in 2006, 2007, and conversely 08, 09. And so there's different times, and what from our research, and if you understand the power of compounding and just the power of timing in general, value investing, these are way bigger drivers of the growth of an investment versus just marginal incremental gains from other types of things. So all that to say, the verticals we're most interested in right now are we still love certain real estate asset classes. We're very bullish on industrial for a lot of reasons. We actually still are pretty bullish on certain sectors of multifamily because there's still a massive housing shortage, and that's causing a lot of kind of stress in that. I think we're going to see a lot of supply coming into the market, but over the next several years, as that's absorbed, I think it's going to be continue to be a good time in certain multifamily. And then, outside of real estate, we're very bullish on oil and gas right now. So you mentioned that you've had some folks on the podcast. That's probably our number one allocation this year. And so kind of how we operate is kind of like a family office where we have 4 partners. All of our partners invest in every single deal that we bring to investors, and it's really our way to diversify our own portfolios. And so we like to invest in things that we want to invest in, and then we let our investors come alongside us. So personally, we're putting most of our allocations into oil and gas this year. Which, if you'd like to get into why, there's a lot of reasons why.
Okay. Yeah. Well, actually, if you don't mind me asking, I know a lot of people, it's when you look at the world of the world economies and world politics. Um, we were several years ago, we had become energy independent again for the first time in a long time. And then with the current administration, we're now energy dependent again. And of course, that reared its head in the early years of the administration with the war in Ukraine and the development or the onset of BRICS coming onto the scene, things like that. But when it comes to oil and gas, or are you looking internationally? Can you make plays internationally, or is it strictly U.S.? Because I know a lot of people are really interested in what's going to happen to U.S. oil and gas. We made a lot of strides over the years with fracking and things like that with the gas part of it, but we still produce a lot of oil. And I don't see that changing any. I mean, maybe in our generation it might change dramatically, but in any case, I'm probably saying way too much. I think what I'm getting is people are really going to want to ask you these questions if they meet you in person. Like what are you seeing, and is it international play, local, state-wise, or?
Yeah, I mean, for us, we only invest domestically and actually just in the lower 48. We don't do any offshore drilling. We like to kind of go more bread and butter, more oil heavy, because if you really look at commodities as a whole, oil is the mother of all commodities. I mean, it's the most energy dense, easily transportable source of energy that we've ever discovered. And it's a foundational part of so many parts of our industry, of transportation, of manufacturing. And, as much as the politics and the, kind of broader narratives are trying to push the transition to green fuels and alternative energy sources, and hey, I'm all for that. I think that's a great goal. Mm-hmm. The unintended consequences are they have created these ESG initiatives, right? Environmental societal governance, where they basically are scoring these big capital allocators, these big PE firms. And fossil fuels are dirty words, and what they're doing is trying to force the capital to move towards green energy. And hey, that's a noble cause. That's great, but the challenge is that it's very short-sighted because we have not found a way to massively produce and store renewable energy in a way that we can use in a sustainable way, in a broad way for our global energy needs. And so what's really happening is if you look at the past 7 years, the actual production, this is all domestically is what I'm talking about. That's where our focus, the production and drilling of new wells has dropped by over 50% in just the past 7 years.
Okay.
So there's been a massive exodus of capital into new drilling. If you think about what oil and gas is, it's a finite resource, right? And so as you're pumping oil and gas out of the ground, you're naturally depleting what's in the reserves of those wells, and about 5 to 7% of total production is depleted every year. And so just to maintain production, you have to be drilling new wells as just a function of the industry, but we haven't been doing that. And so what's happening is we're having this kind of declining supply curve, and it's a little bit of a lagging indicator, right? But it's not something we can just flip a switch on, domestically all of a sudden have all this new production. So that's why they're going to Venezuela and, trying to import more, which is kind of silly when you think about, let's go support this communist country versus we have all the reserves we need here to produce it a lot cheaper. And so there's just kind of mixed messages. And what's happening is as this, excess of capital is left, we're not going to be transitioning predominantly to renewable energy anytime soon. I mean, even the IEA, who's, a big proponent of this in their kind of energy administration, they're predicting that 10 years from now, there's still going to be the same amount of demand for fossil fuels as there is right now. And so just simple economics 101, you and I know, right? If declining supply, if demand's at least equal, it's actually, some people predict it's going to be increasing as we have population increase and the things driving that. We're actually at peak oil demand that we've ever had, surprisingly. That's only kind of saying one thing for pricing, right? And I don't know when that's going to happen. I don't know what all the dynamics are going to be around that, but I like those fundamentals. And then right now, because of the lack of capital being involved in the space, you can buy these producing wells at a really good basis, really good cash flow basis.
Okay.
And you can underwrite them at current pricing. So we're not building any of the price appreciation into our models, but we think the probability is to the upside. So we do employ hedging to minimize downside risk, but we also want as much exposure to the upside as we can.
Yeah.
And so we're very bullish, and it's a long-term play. I don't know if next year we're going to have $100 oil, but we saw little glimpses of that at the end of last year, and some of the investment banks are still predicting we hit $100 oil this year. But we're going to kind of be teetering on this, supply demand imbalance, and we just don't have the backlog of new production to meet future demand.
Yeah. Yeah. Well, I appreciate you going into the explanation. I think a lot of people benefit from that. I lived in Canada for about 5 years, and it's interesting when you look at the trends in the United States, economically, politically, and socially, and every other way, we're heading towards the direction where Canada already is. And it's beautiful people, great country. But if you think gas is expensive here in the United States right now, go fill up your tank in Canada. If you think buying a house is expensive in the United States right now, go buy a house in Canada.
Yep.
So the bottom line is it doesn't sound like it's so much a matter of whether we're energy dependent or independent. It does have an effect on, of course, us going to Venezuela for oil. I'd rather us not be doing that. But let's face it, Canada is one of the most resource rich places on the planet. They haven't even barely scratched the tip of the surface. So they're sitting on a gold mine. Now, unfortunately, they print too much money just like we do. That's why they have such inflation and high prices. And they keep wanting to subsidize everything and bail everything out. And sometimes you got to let the natural laws of supply and demand and free market economy do their job. I mean, that's the inherent design. And if you don't mess with it so much, it actually works really well. We got a history that tells us that. So let's talk about housing a little bit. You mentioned multifamily, and I agree. That's always been my bread and butter. I've done other types of real estate investing, but the old saying, people always need a place to live, and it's true. Between food, shelter, and clothing, that shelter is one of the three things. But the thing that's I'm not sure about going forward is a couple things. One of them is we do have a shortage of housing in the country. There's debate about how much. But let's just say it's 4 million units. I'm not saying that's what it is. I'm just saying like an average of the different figures I get. And the government hasn't really done much to address that. There's policy-wise. However, in California, in Northern California, particularly the Bay Area, they've come up with a program to incentivize investors to build or develop multifamily housing, but for the purpose of rentals, not ownership. Remember, back in the 70s, there was a giant push for more home ownership in the country. And we got it to where it was about a 2/3, 1/3 ratio. 2/3 of all dwellings were owner occupied, 1/3 were rented. Not true anymore. California is approaching 50% rentership now. So their policy is geared towards more rentals, which could be good for investors, except one thing. What they're doing is they're making it so the catch is this. They'll help you develop, they'll pave the way for you to develop multifamily housing in the Bay Area, and they'll even guarantee they're going to give you the rent. The government's going to pay the rent for all these tenants, as long as you don't disqualify people for financial purposes. Well, that's the one thing that you do disqualify people for. Real estate. It's like, and then what do you have? You have basically government taking over the real estate sector. So I'm not saying that's going to happen all over the country, but they've kind of opened up Pandora's box, and who knows? New York might try it next, New Jersey, Illinois. You just don't know. I know in Canada because I've lived there. Just to take, I'm not picking on Canada. I love it there, believe me. But Toronto is a massive, giant city, and their prices just keep going up and up. People can't afford it. But what happens on the rentals is in the wintertime, this wasn't just through the pandemic. They've been doing this for years. In the wintertime, if you have to evict a tenant, you can go to court and get a judgment, but they will not give you possession. You cannot kick out a tenant in Toronto in the middle of the winter. Number one. Number two is, guess who gets to pay the heating bill? The owner. You still got to pay the heating bill. You number one, they're not paying you rent, and now you're paying their heating bill. But there's no recourse for the owner. There's no program in the government to say, hey, don't worry, we're going to pay your mortgage payment for you. you know. So it's a form of government control that takes away from ownership rights and leans towards it. I'm not saying it's good or bad. I believe me, everybody needs a place to live. It's been my whole business in the last 20 years or so. But it's how you do it that matters. So in any case, what I'm getting out of here is this: when it comes to where you're looking for some of the investments, is there a part of the country or states that you're looking at, or did you also keep that domestic also when it comes to housing plays?
Yeah, absolutely. We only invest in the U.S. and we definitely do not invest in housing in California. I mean, there's so many, tenant friendly laws and policies, and it's just everyone. I still think I saw a stat the other day: 3/4 of the multifamily properties in California are still under some type of moratorium from rent, and so they just still can't collect. I mean, 3 years later, so. That's definitely a factor. You're probably right, because if we kind of look at where we're at now, and I probably largely agree with you that the trends are going towards a Canada-like trend where, we're having some wage inflation with it, which is great, but we're having massive housing inflation. I think I've heard up to 6 million units short, somewhere in that 3 to 6 million, depending on how you calculate it and population growth assumptions, et cetera. But regardless, we're having a shortage, right? And we're not going to be able to catch up unless we do a massive amount of new development. And right now we're seeing starts just completely fall off a cliff because, debt is very expensive. It's more challenging to get new deals started. And so we're seeing, I only see this problem getting worse over time. There's a lot of people waiting for the housing crash to happen. I'm going to go buy a property when all the prices come down. It's like, well, you and everybody else, right? And with people especially have locked in low rates before under 4%, which is I think 75% of people, they're just not going to be moving, right? And so there's not a whole lot of supply, regardless of just the normal shortage we have. And so what I think is going to happen is housing prices continue to go up, and meanwhile you have the younger generations kind of prefer the lifestyle of renting versus owning, right? That's kind of more in the mindset of the younger generation. So we'll see how much home ownership kind of becomes a part of their American dream or not. And so I think what that does is it is going to put pressure on housing. It's going to put pressure on rents. And I do think potential for rent control is a factor that you've got to be thinking about, right? And I mean, California does a lot of grand experiments. Sometimes some don't work out, and then sometimes it gets adopted in a broader way. So the simple answer is, I think we're still a little early to say, rent control across the board is going to happen and going to impact it. I really do think it's, we generally like to invest more in the Midwest. To answer your question, we generally like to invest more in red states because they're a little more landlord friendly. But then we also generally will focus on more affordable housing. I mean, we do some kind of nicer Class A developments in markets that are growing a lot in red states, but we also do like affordable housing because what I think part of the thesis is, as rents keep going up, as housing prices keep going up, and wage inflation doesn't keep up with those numbers, we're going to have this kind of bottom part of the market, the lower 50% of the income earners that they just don't have a place to live, right? And they need something affordable. And so the numbers don't pencil out when you're developing new products to develop affordable housing generally. I mean, there's some incentives in certain counties and municipalities that can help to do that. But most of the development that's being done is new Class A, or luxury type product, which is not going to appeal. So it's further creating this gap on the bottom end because all the new supply is only serving the top end. So that's kind of a long way to answer the question, but it's great questions.
We'll be right back with the Massive Passive Cash Flow podcast after I invite you to Monday Night Live. Every Monday night, 7 p.m. Eastern, I teach a class without fail for you on subjects ranging from flipping to buying rentals, managing rentals, wholesaling, commercial, creative purchasing techniques, analyzing properties, identifying properties, hundreds and hundreds and hundreds of subjects. And if you are a licensee, if you have a real estate license, you should definitely tap in because there are a lot of investor agents also in the class. Many of them are on the global investor agent team. So you can learn from them as well as from me how to actually work with investors correctly and profitably. All right, we'll see you Monday night. The link is in the show notes. Go ahead and register. We'll get right to the Massive Passive Cash Flow podcast. Yeah, well, I agree with you. When you look at the shortage of housing, I have heard also between 3 and 7 million units shorted, but maybe it's because they really don't have a solid count on immigrants. They really don't. I mean, it's crazy, but it's true. So in any case, affordable housing. This is one thing I learned in business is when you can identify a need and serve the need, you're probably going to make money.
Right.
And I know right now there's no real incentive for builders and investors to build affordable housing when there's still demand for, like you said, for the A properties. That's where they're making the big bucks. Let's face it, if you and I can build $1 million house and we've got essentially a 20 to 30% profit margin, we'd rather do that, make $300,000 versus build a $200,000 house where there might be, maybe a $30,000 profit margin, or probably less, actually, probably more like 20,000.
Yeah.
10%. It's a mathematical certainty. However, I do believe in the American spirit and the entrepreneurial spirit. And there are solutions like a modular housing now, manufactured homes that are factory built are way, way better than anything we saw as kids. I mean, you can't even tell these things are pre-manufactured. They're beautiful. And the tolerances, like the margin of error, the quality is so much better than the stick-built home. I think it's a matter of time before people recognize that that's going to be part of the answer for the housing shortage, particularly affordable housing. Now, the way they're made, it's not like they're less expensive than a stick-built home, but they're much faster to production and faster to installation. So that's part of the answer is we need housing now. It's not like, we need it in 5 years. No, we need it now.
We need it now. Yeah.
So I know one company, Builtwise, and they only have one factory. There's other companies that manufacture homes, of course, but their model is specifically geared towards this. And they're looking at growth of having, one new factory per year going out the next, 5 to 10 years, because it's one of those things you don't want to ship that thing across country. It's one thing to ship it the next state over. So if they have 10 factories, they'll pretty much have the country covered. Other companies will see what they're doing and I'm sure follow suit. But I think that's part of the answer. And when you can build a 30-unit, apartment building somewhere that's just designed for affordable housing, it'd be nice to have that thing go up in 30 days as opposed to, sometimes it takes them 9 months to do something like that, and, once the production is starting to catch up with the demand, typically the pricing will become more favorable, So,
yeah.
I mean, I'm kind of hoping for that. I keep my eyes on that part of the sector, excuse me. But also geographically, you mentioned the red states in the Midwest. Does it look like to you the Southeast is starting to become getting more too competitive to find a good, because everybody's been going there. Georgia, Florida, Alabama, it's like everybody in there. Tennessee, everybody knows about Tennessee now, but not many people are thinking of like Iowa, for example,
Yeah.
So,
yeah. I mean, it's part of it's just a geographical bias, right? I'm here in the Midwest and I understand the Midwest, and I like the markets because they're just not as volatile. It's just steady growth. But it's surprisingly, actually, Kansas City is actually in the top 10 rental growth markets in the country right now.
Yeah.
And it's just steady Eddie. And so we have consistent population growth. We're never going to have, the massive population growth that Texas has had or Florida has had. But it's just consistent. And I think part of the challenge, there's still good deals to be had. And as an investor looking in, where do I invest? You want to follow population growth, right? Because that generally creates a tailwind of demand. But you also got to contrast that with supply. What's the supply being brought to market? And then how much are you paying for the units? And just generally, I mean, when you're seeing deals trade in, high 3s, low 4 cap rates, especially now where you're going in a very negative leverage with, much higher interest rates on your debt, those deals just don't work anymore. And I think what's going to happen is we're actually seeing the highest number of multifamily deliveries or completions will be brought to market, through the kind of first quarter of next year that we've ever seen, right? And obviously, if you adjust for population, adjust for the shortage, we need all of the units, but it's gonna, I think, create this kind of dip in demand for the next 12 months, especially in those markets that were kind of oversupplied as they're absorbing the new product. So I'm just not as bullish in the short term on those markets. I do think population growth matters, but that's where everyone else is looking. And, I tend to be a little more contrarian and try to find value and, play the game for the long term. So, part of the challenge multifamily too, aside from just the supply and demand factor, is we saw a lot of the deals that were purchased in the past 2 years, really anything 2020 and beyond, was purchased a lot of times with bridge debt. And if you understand kind of how bridge debt works, they're generally got 3-year maturities. A lot of them are floating rate debt. Sometimes you can buy a rate cap that can, maximize or put a ceiling on how much interest rate can go up to. But a lot of these deals that were purchased were when rates were really, really low, a very high leverage, 80 to 85% leverage. And they had very aggressive business plans. They don't cash flow day one. They have to increase rents massively. And so you have all these factors that are putting a ton of pressure on these deals. And so I think over the next 5 years, there's $1 trillion worth of commercial real estate maturing in just the next couple of years. And there's Fitch is a big ratings agency that put out a report recently forecasting that of the deals that are, notes that are maturing this year in 2023, 25% of them will not qualify for a refinance.
Whoa.
Either mostly due to debt service coverage constraints. They're not cash flow positive, or they don't have enough income to service the debt when it starts, when it amortizes. So they don't have any option, right? At that point, the lender either has to extend the note and hope that they can raise the income enough to meet it. But right now we're having slowdown in rental growth, especially in the southern, Smile states, not so much here in the Midwest. And then you have expenses are going up. They're kind of been lagging behind rent rates, but they're kind of coming up a lot. So you have this kind of squeeze down of operating income. Meanwhile, all this maturing debt that is going to, need to have an answer. So the short answer is I think we're kind of headed for a short-term kind of turmoil. I think there's going to be several deals that go bad. I don't think it's going to be a big, 2008, 2009 crisis, but I do think there's going to be several deals. We're already starting to see the beginnings of that. And what that's going to do, I believe, is create a lot of opportunity to buy good value at a good price for an asset class that still is going to perform well over the long term. But now you can get in it at better rates or better cash flow.
No, I agree 100%. If you look back in the last, since the pandemic, right? A lot of commercial space, there was a lot of empty spots, a lot of empty storefronts, and look at the malls across the country. So some malls are actually doing okay. It's crazy, but other malls, they're ghost towns. They're just empty. But a lot of commercial space took a pretty good beating. And now you've got the debt scenario you just described there. And I know the commercial banks, how I used to be a banker, and it's weird how it works. Once a commercial lender calls in a note on an investor, they all talk. There's actually a process for it, believe it or not. They do communicate. The banks do communicate. Well, all the other lenders that have notes with that borrower, they're going to start calling the notes. This is what happened in the last recession. Some great investors went down because there was an avalanche, and it would just like one person decided, well, we need that cash back. We have to call in a note. And the other lenders, they don't even question why. They just think, so-and-so called their note. We better jump on real quick. And that's what happened. They pile on. I'm not trying to scare people, but if 25% of the properties don't have the debt coverage ratio because of what's been happening the last few years, they may have to face the music and pay the piper. But I want people to remember this. It doesn't mean it's time to panic. It's time to prepare.
Yep.
And for those who are prepared, you're probably going to make a lot of money. That the last recession, very painful for a lot of people. I get it. Believe me, I'm in the business. But it was also the largest transfer of wealth in the history of the human race. Happened in those years. And we happened to have a brokerage that served investors, and it was ridiculous the amount of growth our business experienced because of the massive volume of transfers that were going on, and a lot of good deals. I mean, people that had the cash and the credit, essentially, you look at the prices the last couple of years. If you'd have bought in 2008, 9, and 10, and sold in the last 2 years, you're probably set for life. So, hey, I know we're getting short on time here. We talked about oil and gas and real estate, and I'm sure there's other sectors, but for the sake of time, what's the best way for people who do like to invest part of their income passively? Because we have a lot of those folks here that are on the podcast. How can they get a hold of you and do some information gathering, and maybe touch on if they have to be accredited, or if there's a possibility for non-accredited investors? What can we do there?
Yeah, absolutely. So our website is aspenfunds.us. And I can send you a link to put in the show notes, but you can check out, we have several offerings right now, and several of the verticals we discussed today. And, they are limited at this point to accredited investors. But what we do is once a year, we will generally open up a offering for non-accredited investors. And so, if you're kind of on the bubble, or you're kind of just getting started, do reach out to us and have a call with us, because then we can, establish a relationship, and that allows us to, kind of share things when they come available. But you have to reach out to us to do that, for us to be able to legally share it with you. And then, if you like podcasts and want to check out our podcast, it's Invest Like a Billionaire. And I think, Gary, you and I, we share a passion for the same thing of just helping educate people to think differently, right? Because it's so easy just to go in fear mode and panic mode, like you were saying, if the headlines are all doom and gloom. But a lot of times that's when the best opportunities are presenting themselves, right? And so you have to be, feeling your mind and putting, the right information in at the right time. And so that's our goal too, is really help train people how to invest wisely. And there's a lot of turbulence right now, but it's also going to create a lot of opportunity. And we need to be, head on a swivel looking for that opportunity in the next kind of 12 to 18 months.
Yeah. It's funny, kind of a comical commentary here. If you think about the mainstream news, right? It generally, when they start off, the background music is very ominous. It's almost like the theme from Jaws,
Right.
And then it's like gloom and doom, Washington, D.C., stay tuned at 6. But no news anchor ever gets in there and says, hey, this is awesome, man. This is going to be the biggest transfer of wealth we've ever seen. A lot of people are going to be made rich. They never say that stuff. It's all gloom and doom. So we have to, it's inherent upon us, particularly here in our country, because of our unique nature. We're still, in spite of what sometimes we see on the news, still the greatest country in the world, hands down, economically, military, every other way you can possibly imagine. People are coming here. People are fighting to come over our borders. You don't see Americans fighting to get over the Canadian border. I'm not, again, love Canada, but Americans aren't fighting to get into Canada. We've got people fighting to get over our southern border because it's awesome, and keep that in mind, and gather information from multiple sources. Go to aspenfunds.com, gather some information, listen to the podcast. It's Invest Like a Billionaire, right? That's the podcast.
That's right. Yep. Invest Like a Billionaire.
There you go. Positive thinking, feed your mind with positive information and education like that. So Ben, I want to thank you again for being on here. This was a lot of fun, because we went totally off script, but man, you provided a lot of good content. And let's face it, what do Americans love? We love our houses and our cars. And your two sectors primarily are housing and oil and gas. And I know there's other things you do, but it doesn't get any better than that. You stick with what works, and you guys are certainly doing it. And I'm so glad we had you on. And for everybody listening, if you could, please, you don't mind, leave a good review. That's what makes the podcast go around. It doesn't cost anything, but we put a lot of time, energy, and money into it. So we just ask for your review, because that's the currency that allows us to keep going. Your review does that, so we appreciate it. And while you're out there, again, visit aspenfunds.us. Okay, remember it's a .us at the end, aspenfunds.us. And before you leave the internet, go visit globalinvestoragent.com. If you're an investor, you can select an agent there who's trained to work with you. These are not typical agents. These are investor agents. And if you are an agent, I really encourage you to click on the Learn More button to see how you can make this part of your brokerage model heading down the road. You heard it here today. I mean, the market's already starting to shift. We already know it. It's a mathematical certainty. We can't tell you how bad it's going to get, how long it's going to be. All we can tell you is it's going to happen. But don't panic. Why not prepare? Think like a Boy Scout. That's the Boy Scout model. Be prepared. So I'll leave you with that. In the meantime, we'll see you on the next Massive Passive Cash Flow podcast. And God bless you and your family.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.